Hello everyone. So now we are starting with the revision of the book 4, that is our valuations and risk model, and as discussed, the first three chapters and the last three chapters are very important from this particular session. Okay, so let us start the discussion with the first concept, that is VAR, value at risk. Okay, so let us start with the concept of VAR. You can keep the heading VAR. Clear? Let me change the pen. Yeah. So VAR is what? Value at risk. Value at risk. Clear? Let us take a small example to understand it. First of all, what is the formula if I want to calculate the VAR? What is the formula? It is mu minus z multiply with the sigma multiply with the portfolio value. Okay. If you want to find out the value in the absolute terms. Clear? Suppose your portfolio value is 1000. Your portfolio value is 1000 and suppose your mu is 4%, and you are calculating it for 95% confidence interval. So z is 1.96, and suppose sigma is 2. Clear? So in this way you can find out the VAR. You just need to solve the equation to find out the value of the VAR. Next, very important point, what are the four properties of the coherent risk measure? Write down what are the four properties of the coherent risk measure. Number one is the monotonicity. Okay, write down the second point, subadditivity. Third point, positive homogeneity. And the fourth point, write down translation invariance. Clear? These are the four properties of coherent risk measure. Clear? Then VAR, it talks about the risk in the tails, but for a single point. It ignores everything towards the right, it ignores everything towards the left. Clear? Then the better solution for the calculation of the risk is the expected shortfall. If this is the point, then it will calculate the VAR of the tail at different points, and then it will take the average, where I am giving equal weights to all the values. Clear? But I am ignoring this part. This is expected shortfall, a better version of the VAR, a better version to find out the risk of the organization, because you are not just considering a point, you are considering the whole tail to understand that what is the possible amount of loss. Clear? And there is a formula to calculate the expected shortfall. What is that formula? Mu plus sigma bracket open e to the power minus z square by 2, then divided by 1 plus x root over 2 pi. 1 plus x root over 2 pi. Clear? Now let us understand the point. Mu, we know the mean. Sigma, we know that it's a standard deviation. Z is the z value, okay, which will come from the probability table. What is x? X is the confidence interval. Sorry, this is going to be 1 minus x. Okay, 1 minus x. So this is confidence interval. Clear? In the question, these all four information will be provided to you. You just need to put that into the formula to find out the expected shortfall. Clear? Now coming to the next point, if I'll ask you, tell me the four reasons why expected shortfall is better than VAR. So the first reason is that expected shortfall satisfy all four properties of coherent risk measure. Expected shortfall satisfy all the four properties of coherent risk measure. Clear? VAR will also satisfy all the four properties of coherent risk measure, provided if only this condition met, then only VAR will satisfy all the four conditions of the coherent risk measure. What is that condition? The condition is that the data is normally distributed. Clear? This is the first point. Clear? Now let us move to second point. The surface for expected shortfall is convex. the surface of expected shortfall is convex. Now what is the reason for this? The reason is subadditivity, the property of subadditivity. Clear? Now coming to the third point, expected shortfall is able to measure the magnitude of the loss, that what can be the possible loss, but VAR is unable to figure out. Why? Because VAR is just about a point, but expected shortfall taking about the area. So you can tell me now what is the probable loss. Clear? Next, about the assumptions. So VAR have more assumptions as compared to the expected shortfall. That's why these are the four reasons expected shortfall is preferred over the VAR. Next is the risk spectrum. It is a more better version of the expected shortfall. Okay, like in the expected shortfall, we are giving equal weights, right? We are giving equal weights, but giving equal weights to the highest possible losses and equal weights to this loss is not a justice. So we should give them different weights. We should give them different weights. And how we will find out their weights? 1 divided by 1 minus confidence interval, you can say x. This is how we give them the weights. The more we'll move ahead, the x will increase, and if the x will increase, the denominator will decrease. Clear? Are you getting the point? Now coming to the next point, that is about the historical simulation. Historical simulation means taking the historical data and arranging them from left to right and then cutting one point, and that will be your VAR. We call this as historical simulation. Clear? Also we have another approach, we call this as delta normal approach. Delta normal approach. Delta normal approach. Clear? In this we are going to calculate the VAR with the help of the distributions, or you can say with the help of normal distribution. Clear? But there is a problem with the delta normal approach, is that it works only for those portfolio which are linear in nature. Those portfolio which are linear in nature, like forwards, futures or stocks. Clear? But if I talk about, can I use delta normal approach for call options or put options, or can we use it for swaps? No, it will become difficult. Okay, because these are non-linear portfolios. Then what is the approach to calculate this risk of these options? So the solution is full revaluation approach. In this, first of all, we will value the underlying in the worst case scenario, and then based on that valuation of the underlying, we will find out what is the value of that options, and then we will find out what will be the loss or profit in that situation. Clear? And this is highly used for embedded options securities or mortgage backed securities. Embedded option securities and mortgage backed securities. But there is one problem with this approach. It is highly computational. Like you have seen that VAR is very simple. Just get the mu and sigma and the value of the z, you can find out the VAR. But these approach are highly computational. You need to find out each and every component in the step. So you need to value each and everything. Clear? Next point, write down, is the contagion effect. Clear? So what will happen in this effect? Your sigma and the correlation between the asset, they both will rise. Clear? And when correlation is rising, correlation is very high, or correlation is equals to 1, we always say na, there is no benefit of diversification. So we call this as a contagion effect, where the volatility is rising and the correlation among the assets, they both are rising. And if the correlation will rise, the benefit which earlier I am having by constructing a portfolio because of multiple assets, I assume that their correlation is low, and hence my risk return reward is very high. So that effect, that benefit now vanishes during this time period. Now write down the two approaches of estimating the VAR. One is the parametric, and another one is non-parametric. Parametric means you assume that how the assets returns are distributed. So there are two assumptions: the assets are either normally distributed or log normally distributed. But in case of non-parametric approach, you do not make any such type of assumptions about the distribution of the price of the assets. Clear? So here you have two methods to actually find out the VAR. One is the historical simulation method, historical simulation method, and the last is the multivariate density density estimation method. Clear? The multivariate density estimation method. Okay, so now write down next point: key sources of country risk. Give the heading: key sources of country risk. Write down first point: the level of country's economic growth. The level of country's economic growth. Write down second point: political risk. Third point: legal risk. And the fourth point is economic structure. These are the four key sources for a country risk. Now if I ask you about the two things, there are two companies which is just in the early stage and one which is in the mature stage. Which one is more risky? The company which is in the early stage, because now it will have to see all the phases of whether it's a growth phase, maturity phase, stability phase. But the company which is already working since years, okay, they have the stabilized capital structure, they have the stabilized amount of workforce, risk, parties, everything. Okay, they have the experience of the market, different cycles of the market, everything. Clear? Now these points are very important when it comes to the measure of the credit risk. Clear? What are the components for the measure of the credit risk? We have probability of default, we have loss given default, we have exposure at default. Which one is most difficult to identify? This is something which is most difficult. This one is the easiest. Because you know that what is your current outstanding. Okay, that will be your exposure at default. Clear? This is something which you can find out based on the behavior of the past behavior of that person, or the balance sheet of that particular person, the income and the assets which a person holds, that how much loss he is going to make. But the probability of difficulty is very difficult to model. That's why you will see most of the time you are focusing on modeling the PD, that if this particular Mr. A, what is the probability of default for Mr. A? If there is a company XYL Limited, okay, what is the probability that he will default on his loan? What is the probability? So this is the most important discussion in the credit risk area, is to model the probability of default. Clear? So there is expected loss which you need to calculate. Expected loss is something which is priced in your interest rate, and this is something for which you have already created a provision. So how you will find out the expected loss? It is the probability of default multiplied with the loss given default. Suppose your probability of default is 1.8% and your loss given default is 40%. Then what is your expected loss? 0.72% of exposure at default. Clear? This is your expected loss. Clear? Now next point is from the operational risk categories. What are the 7 major areas where you identify the operational risk? One is the internal fraud, then external fraud. Okay, internal fraud means you are disobeying the laws, rules, regulation, company policies, misrepresenting the data, employee theft, insider trading. These all are internal frauds. What is external fraud? External frauds is misusing, okay, robbery, computer hacking. These are external. Then employment practice and workplace safety, client products and business practices, Damage to physical assets, very easy to understand that earthquake, terrorist attack, okay, these all are damage to physical asset. Business disruption and system failures, okay, might be software related, might be hardware related. Execution, delivery and process management, clear, these are the operational risk, 7 categories. Now if you want to calculate the operational risk, there are three approach. One is the basic indicator approach. Let me write it down this for you. The three, very important, okay, it can even come in exam. So what are those three approaches? Number one is basic indicator approach. Basic indicator approach. Basic indicator approach. Next, standardized approach. Standardized approach. And the third one is advanced measurement approach, AMA, advanced measurement approach, clear. Now when you are defining the operational risk, okay, it is divided into two parts. One is loss frequency, how many number of operational losses are there, how many number of operational losses are there in an year, and loss severity, how big they are, okay, are they very big of thousands of crore amount, or they are very small, 500, 600 or $700, clear. So what is loss severity? It is defined as the probability distribution of losses. It is defined as the probability distribution of losses. It is defined as the probability distribution of losses, clear. And what is the frequency of losses? It is defined as the average number of losses in 1 year. Average number of losses in 1 year, clear. Okay, now write down the next important point from the same chapter is the power law. Give the heading the power law. Write down, it is useful when evaluating the nature of the tail. It is useful when evaluating the nature of the tail, when you are going deep inside the tail of a given distribution, of a given distribution. So power law is useful for the tail, okay. The use of this law is appropriate. Write down, the use of this law is appropriate because operational losses are likely to appear in the tails, because operational losses are likely to occur in the tails. Then law states that the range of the variables which are greater than x is proportionately or approximately equals to k x minus alpha, clear. K and alpha, these two are the parameters of the power law. They two are the parameters of the power law, and x is the high value of the random variable. X is the high value of random variable. Okay, so our next point of discussion is the stress testing. Write down, extreme event tends to have low probability of occurrence, it's true, with a high impact, even if their probability is low, but if one of that event will take place, then its impact is going to be very high, because these losses are of very huge amount, clear. So write down next point, stress testing is designed to show how an institution will respond to these type of events. Which events? Which are very big, which can occur only like 1 out of 1000 times. So how you are going to behave, how you are going to treat them, okay, how you are going to respond them if any such event will take place, clear. So what are the possible way? Either you should have enough capital, or you should have enough amount of liquid assets in your hand, clear. Write down next point, institutions use reverse test testing. Institutions use reverse test to assess the event that are outside of the normal business expectation, clear. When we are using the reverse test testing, when a scenario is outside my expectation, clear, and I will hypothetically assume such type of expectations, anything such which can threaten me, which can create issues for my organization. In that scenario, in that type of situation, we will use reverse stress testing. Clear? But the normal stress testing, they are forward looking. And they will not provide you any type of probability for the losses. Just like war, it will tell you now that there is 95% chances that your losses will not exceed that much. Stress testing is not going to give you any type of probability. Okay, so don't hope or don't expect that what is the probability for this amount of loss. No probabilities are there. It is a forward looking, but it will not provide you any type of probabilities. Clear? While you are testing the stress scenarios, your horizon is very long. When you will compare it with war, 1 day war, 2 day war, 1 week war, but stress testing usually takes in years. Clear? And they are going to capture only the negative events, means the negative events over the last 10 years. What are those events? Clear? Might be the corona, might be the war between Russia and Ukraine, might be the GST, might be the issue of new currencies, presidential elections. What are those areas where the market got impacted badly? Clear? So only negative events will be captured. And the last point is the number of extreme scenarios tend to be relatively small. As I have discussed earlier, that over here those scenarios are very small, 1 out of thousands, 1 out of 1000. Clear? Next, these stress testing, it can serve as a warning sign. Okay, if there is something wrong going to come to your organization, it will give you the warning sign. If such and such take will happen, then you are going to suffer such and such amount of losses. Then board of directors can take the action. Then board of director will definitely take some amount of action after having this stress testing report. What they will do? They will improve their capital, they will increase the liquidity, they will adjust the amount of risk, and if they feel that some projects which seems to be very risky, they will close them off. Clear? What are the steps they will take? They will increase the capital, they will increase the liquidity, they will adjust the risk, means they try to reduce the risk. Or there are certain activities, certain projects in which they have heavily invested and which are very risky, they will withdraw their hands, they will withdraw their money from them. So board of directors, they have the complete oversight, responsibility and accountability for the entire institution. Those senior managements are working, but who is responsible and accountable? It's the board of directors. Clear? Whatever is coming from the board of directors, that senior management deploy. Clear? Their task is for the implementation. Clear? So senior management is responsible for implementing the authorized stress testing activities which is pre-approved from the board of directors. Clear? Then senior management will use that stress testing report. Okay, they will combine it with the scenario analysis and what is the decision done by the senior management or the board members. Clear? Then the next point is about the validation and the independent review of the stress testing. Validation and the independent review, it's very important. Okay, that will include the review both from the qualitative perspective as well as the judgment from the experts, qualitative as well as the judgmental aspects of the stress testing report. Clear? Validation and independent review, it includes both. See, stress testing gave you the quantitative number. Now your responsibility is to take the qualitative part as well as the judgmental part from the expert side. What they actually see in that. Clear? So expert judgment is required. Clear? Now the test means you are creating a model and you are testing it, so you should test it in the stressed environment. Then you will see that how much worst can come to your organization. Clear? So you must communicate this stress testing details to every users of the risk management who are actually using or who are actually managing the risk of the organization. Next, the internal audit team. Okay, the internal audit team, they are also play their hands in the stress testing. They review the manner in which stress testing efficiencies are identified, tackled and remedied. Clear? So their task is to identify, to track and to give the solution, to give the remedification for it. Clear? And the last point, stress testing objective should align with the overall risk management framework for the institution, means you are taking it from the management, the whole institution, the whole organization as a whole. Okay, if you are reviewing it twice a year, that's more than enough. Okay, results should be communicated with the board of directors as well as the senior management. And if there is a mild risk, okay, if there is a mild risk, then you should communicate properly, clear. But risk should be extreme. So stress testing should focus mainly on the major risks. Small risks are not their area, clear. Now let us enter into the fixed income area. Okay, so write down, for a continuously compounded spot rate, for a continuously compounded spot rate, the formula which we are going to use is dt e to the power minus rt, clear, multiplied with the t, clear. This is we are going to use for the continuously compounded spot rate. Always remember that you are going to use the exponential, clear. Now coming to the next point, that if your yield curve is upward sloping, if your yield curve is upward sloping, where you are estimating that the long term interest rates are greater than the short term interest rate, then the forward rate will be the highest rate. And we all know that forward rate will lie above the spot rate, and it is also upward sloping, it is also upward sloping, clear. Now the next point, write down bull flattener, bull flattener. Write down, a decline in long term rates, a decline in long term rates, your long term rates are declining, a decline in the long term rates which is greater than the decline in the short term rates. This decline is greater than the short term rates, means long term rates earlier it was 10%, now it came down to 7%. So there is a decrease by 3%. Short term rates currently 5%, and now it is only say 4.5%, decrease only of 0.5%. See, they both decreased, but the long term rates decrease more as compared to the short term rates, clear. Write down next, a bear flattener occurs, a bear, this one was the bull, next is the bear flattener. It occurs when short term rates rises more than the long term rates, short term rates rises more than the long term rates, clear. This is a bear flattener. Then bull steepener, bull steepener occurs when short term rates falls faster than the long term rates. Write down, short term rates falls faster than long term rates. See, they both are falling, but which one is falling faster? Short term rates, clear. While a bear steepener occurs when long term rates increases at a faster rate as compared to the short term rates, clear. These are the four important points, clear. Bull flattener, bear flattener, bull steepener, bear steepener, clear. Now write down next point, it's about a callable bond, callable bond. See, I am covering the important points, okay. Trust me, in 40 minutes you cannot cover up the whole book, each and every point, clear. Write down, callable bonds have reinvestment risk, callable bonds have reinvestment risk. You know why there is a reinvestment risk? Because if the interest rate will rise, then bond will not be callable. But if interest rate will fall, company will call the bond, clear. Now you have to reinvest that money at a lower rates, because in the market the interest rate are lower. When you have invested, the rates are 7%, but now the rates are only 3%, so you have to bear that loss, clear. So callable bonds have reinvestment risk because the principal can be prematurely retired. See, this is the principal and it can be prematurely retired. The company will give you the principal back. The higher the coupon, the higher the reinvestment risk. The higher the coupon, the higher the reinvestment risk. Try to understand. See, if you hold a bond and the company is giving you a coupon, clear, but the time you have invested, that time interest rate was 7%, but now the interest rate decreased to 4%, clear. Now you have the money in your hand, you have to invest it. Where you will invest? In the market. What you will get in the market? Only 4%. So the higher the coupon, the higher the reinvestment risk, holding all else equal, clear. A bond being issued at par has nothing to do with the reinvestment risk. Write down, a bond being issued at par has nothing to do with the reinvestment risk. Clear? Why? Because whatever is the YTM of the bond is equals to the coupon of the bond, is equals to the coupon rate of the bond. So your coupon rate is not more than the YTM. If the coupon rate is more than the YTM, then the risk of that reinvestment arises, holding all else equal. Now next point is about the duration. Write it down. Duration measure assume a parallel shift in the yield curve. Assume a parallel shift in the yield curve. Assumes a parallel shift in the yield curve. Duration is not a good measure. Duration is not a good measure. Duration is not a good measure of non-parallel shift. Clear? So duration measures mostly for the parallel shift. When it comes to the non-parallel shift, duration will not work best for you. Now write down next point. A barbell strategy is typically used when an investment manager uses bonds with short term and long term maturity. Means I am an investment manager and I am purchasing or selling both long term as well as short term bonds. Clear? My focus is on both short term as well as on the long terms. Clear? Then I'll use the barbell strategy. Clear? Thus foregoing any intermediate term bond, means I am not thinking about the intermediate, means I am focusing on the 1 year bond and I am focusing on the 30-year bond. In between I do not have any type of focus. Clear? This is a barbell portfolio. Clear? Of bonds. If I talk about the bullet, what is there in the bullet portfolio? When the investment manager buy bonds concentrated in the intermediate bonds, when my focus is in the intermediate, neither in the short term neither in the long run, when my focus is the intermediate bullet portfolio, when my focus is in the short term and the long term barbell portfolio. Now next point, convexity is the sensitivity of duration. Write down, convexity is the sensitivity of duration to change in the interest rate. If the interest rate will change by 1%, because of which how much duration is changing, that is captured by the convexity. Clear? Convexity is positive. Why it is positive? Because if the interest rate will change, duration will change. And hence the change is captured by the positive convexity. Clear? And will always increase the price, calculated by duration only, But when you combine the duration and the convexity both, when you will combine them, you will be getting the better estimate of the bond price when the interest rate will change. That's why it always said never use the duration or convexity as an individual, combine them together and then find out the change in the bond price with the change in the interest rates. Okay, now single factor models. Write down, single factor models assume that any change in any rates. Single factor model assumes that any change in any rates, means there are short term rates, there are long term rates, there are intermediate rates. Clear? If any rates changes, whether short term rates, whether long term rates or intermediate rates, so it assumes that any change in any rate across the maturity spectrum can indicate changes across any other portion of the curve such that all interest rates move in the parallel fashion. Means currently the interest rate is like this. Suppose the interest rate is like this. It is saying that if the interest rate of the third year increase by 1%, then they are saying that the interest rate will increase by 1% across all maturity. Clear? Are you understanding this point? Now write down next point. Key rates for US treasuries Key rates for US treasuries are typically 2, 5, 10 and 30 year maturities. Key rates for US treasuries are typically 2, 5, 10 and 30 year maturity. Clear? 15 is not there. Then key rate duration is a measure of percentage change, not the dollar change. Key rate duration measure the percentage change, not the dollar change. What measures the dollar change? You remember Macaulay duration. Macaulay duration. Clear? But key rate duration is a percentage change, not a dollar change. Clear? The relevant change in the yield is 100 basis point, not 1 basis point. Key rate duration is for 1%, not for 0.01%. Are you clear? Are you clear? See, if you are expecting now that everything can be covered up in the 40-minute session, next to impossible. So I am covering those areas, okay, which are quite important, okay, which students tends to forget. Clear? The probability for the up move, e to the power rt minus d divided by u minus d. Trust me, you can expect question from this area. What is the probability for down move? 1 minus probability of up move. 1 minus probability of up move. Clear? Are you clear with this area? Next, write down the higher the standard deviation, the greater the dispersion between the stock price in up and down states. We draw the tree, remember? We draw the tree like this. Clear? If there is a higher standard deviation, then the difference between the two nodes of the tree is also going to be the highest. Clear? Volatility as measured by standard deviation can be captured by evaluating the spot stock price at each time period considered in the tree. Clear? So every time we are calculating the volatility. The size of the upward and downward movements are defined as function. Write down. The size of the upward and downward movements are defined as function of the volatility. How that gap is defined between the two nodes, that comes from the volatility, and the length of the steps in the binomial model. Length of the steps means whether your model is 2-period binomial model, 3-period binomial model or 300-period binomial model. That is also very important. Clear? Write down next point. As time intervals are shortened, as you decrease the time period, the price produced by the binomial model will converge towards the Black-Scholes-Martin model price. Means if you will decrease the time interval between the two tree, means first tree you are making, okay, that is after only 10 minutes, again you are making the tree after 10 minutes. The more you will decrease the time between the next node, your model will become Black-Scholes-Martin model. Clear? Which assumes that you are doing it at a continuous level. Now let us revise the assumptions of the Black-Scholes-Martin model. Number 1, the options are European. Markets are frictionless, means no taxes, no transaction cost, short selling is allowed. Clear? The underlying asset generates no cash flow, means there is no dividends, nothing. Clear? Trading is continuous. Your volatility is constant, known and always visible. Then risk-free rate is known as well as it is continuous and it is constant. See, word continuous is very important, and the price of the asset is log normally distributed. Next, if the call options are not paying the dividend, then American options will be equals to the European options. Next, the American put options, okay, if the company is paying huge amount of dividends, in that situation it is very unlikely that you are going to exercise them. Clear? It is very unlikely that you are going to exercise them. Clear? The value of the put option increases as the dividend is paid. The value of the put option increases as the put option is paid. Why? Because now there is high chance that you will exercise your option. Write down next point. If the relationship between the forwards and the underlying asset, is 1-to-1, because we know that if the share price is moving upward, the forward will also move upward, and hence the delta between the stock and the forward is always equals to 1. If anyone will ask you what is the delta between the stocks and the forward, it is going to be equals to 1. It is generally behaves like a in the money option. It generally behaves like a deep in the money option whose delta is equals to 1. Write down next point. Stop loss trading strategies are designed to minimize losses. Stop loss trading strategies are designed to minimize losses in the event the price of the underlying assets, in the event the price of the underlying exceeds, in the event the price of the underlying exceeds the strike price of a short call position, the strike price of a short call option position. Clear? Stop loss trading strategies are designed to minimize losses in the event the price of the underlying exceeds the strike price of a short call position. Clear? Then what is theta? Theta is referred to as the time decay of an option. Is referred to as the time decay of an options. So it measures the sensitivity of the option price to decrease in time. You cannot say increase in time. So time will always decrease. So if the time is decreasing, how it is going to impact the option price? Gamma. It measures the sensitivity of the option price to the change in the option delta. If delta is changing, then how much delta is impacting the price of the share, price of the option. Vega. It measures that if volatility is changing, how much it is impacting the price of the asset. Rho. It measures the sensitivity of the option price to the change in the interest rates. If interest rate is changing, how much it is going to impact the option price. Clear? So I have touched upon quite few important topics. Clear? 40-minute session was there, so I have tried my best to capture all these points. Okay, so I am ending this lecture here. Thank you.